Fed has raised interest rates again. What's the potential impact on investors, especially income-oriented investors? Advisor Dorothy Bossung of Lowery Asset Consulting in Chicago shares her view.
Rate hikes are an interesting and challenging time. We've been experiencing them on a very slow basis over several years now, as the Fed has very, very slowly raised the short-term interest rate. They've done it cautiously because they're following a time of quantitative easing, which is not something we've really experienced at this magnitude before.
One factor often associated with rising interest rates and economic growth is inflation. What are the current assumptions about inflation, and how do you feel about future expectations?
Well, we've been waiting for inflation to raise its ugly head for a number of years, and we try to stay continually prepared for that. When the wage report and the unemployment report came out in early February, there was a surprising bump, or a bump that was greater than what the consensus expected, and that created a great deal of volatility in both the equity and bond markets. I think that it's fair to say, with unemployment as low as it is, that you could certainly expect to see something in the way of wage inflation.
In a rising rate environment, in your opinion, where's the greatest risk for investors, and where do you see potential opportunity?
The risk is there for investors who are underinformed as to the potential volatility of their investments. Any bond fund manager that you interview, though, will tell you that they're much happier to be in a rising rate environment than one that is simply flat or going down, because it does provide a great deal of opportunity for them to manage the portfolio and take advantages of shifts in bonds as they move closer to maturity.